How exactly could you turn $1 into $1 million? And would you actually know what to do at each step? Because the skills needed to go from $1 to $1,000 are a lot different than the skills needed to go from $999,000 to $1 million. And in today's video, we'll be going through the steps needed to go from $1 to over $1 million. And if you're new here, hi, I'm Queenie and I'm a licensed personal finance creator, meaning I've earned a license to give general financial advice. And in today's video, I'll be going through exactly how I'd invest $1 all the way up to $1 million, because the steps are honestly different at each milestone. Keep in mind that this video is general advice only and not personal financial advice. You can read my full financial services guide in the description. Thank you so much to Perla for sponsoring this video, but I'll talk more about them later in this video. So the first step is to build your foundation. Before we even think about investing our first $1, we need to set up the foundation. The first thing that we need to build is an emergency fund of 3 to 6 months of living expenses saved in cash in a high interest savings account or in an offset account if you have a mortgage. Your emergency fund is your safety net. It's there to be used in cases where you lose your job, you lose income, or if any unexpected emergencies pop up in your life. It's money that you can access immediately whenever you need it. So you don't have to sell any of your investments if something goes wrong. And the reason why it's good to have an emergency fund saved in cash rather than just investing all of your money is because if something happens and you do need some emergency money, if you dip into your investments at a bad time in the market, this can cost you a lot of money over the long term because investments can go up and down. So if you have to sell your investments at a bad time in the market, this could cost you a lot of money. And I know 3 to 6 months of living expenses is a lot of money to save up initially, but you can always start with a $1,000 emergency fund and then build it up from there. Also make sure that you check in with your emergency fund and make sure it's appropriate for your life at the time, because things always change with the cost of living, inflation, and also just lifestyle changes. So let's talk about going from $1 to $1,000 once you have your emergency fund in place. Once you do have your emergency fund saved, it's a good idea to look into investing, because each year the value of our money decreases with inflation by about 2% per year. This means that if we have all of our money sitting in a bank account, it's essentially losing money because of inflation. Of course, having an emergency fund is really important, like we discussed in chapter 1, but any money over an emergency fund is essentially just losing money because of inflation, and it's a good idea to redirect those funds into investments. So this stage is all about building that habit and that muscle when it comes to investing, because if you know how to invest $1 or $1,000, it makes it a lot easier to invest bigger amounts of money over time. And the great thing is, with today's day and age, you don't need heaps of money to start investing. You can literally start investing with $1. And there are amazing investing apps like Perla which make it super easy to start investing, but I'll talk more about them later. There are also these amazing products called ETFs, which means that you can start investing in diversified investments with really small amounts of money. So this is the difference between buying a stock and buying an ETF. With buying a stock, you're essentially just investing in one company. Let's say, for example, Apple stock. So you're betting that Apple does really, really well over the next couple of years. They might do really well, or they could underperform the market. And that's why some of the biggest investors in the world, for example, Warren Buffett, recommend that people invest in something called ETFs. ETFs are basically a basket of different shares in one investment. So instead of betting on one company doing well, you basically buy a basket of different companies that represents an index. And the stock market as a whole tends to go up over time. One caveat though is if you are looking to invest in the stock market, it's a good idea to hold on to your investments for at least 5 years or more, and this can help you wait out the volatility in the stock market because it does go through highs and lows. Some popular ETF combos are VAS and VGS, and this covers the Australian market and the international stock markets without them overlapping. Then there's also FAIR and VESG for an ethical version. If you want to invest in the top 500 companies on the US stock market, there's another ETF that you can purchase which is called IVV. Keep in mind that these are just examples and not recommendations, and it's important to do your own research. If you're looking to invest smaller amounts of money, say less than $1,000 or less than $650 at a time, then Perla Micro could be a good option option to look into. They have a low monthly fee of $2 per month regardless of your balance for one fund, and this keeps things simple and predictable. But keep in mind that other fees and costs such as the cost of the underlying ETF may apply, so check the PDS for more info. You can also choose from a range of about 10 different managed fund options that track ETFs, so you can get instant diversification even if you're not investing huge amounts of money straight away. So even if you're just starting with $5 or $50, it's important to keep investing and keep that consistent habit, because once you know how to invest $5, you'll find it so much easier to invest bigger amounts of money, and you'll learn a lot too. At this stage, it's less about growing money really fast, and it's more about shaping your mindset around wealth and becoming the person that is investing consistently and is becoming good with managing money and handling money. I would say it's the stage that's probably the hardest, because it will require you to be a lot more frugal and a lot more mindful about how every little expense adds up. I still remember being at this stage. I was renting, I hadn't invested money yet, but it was something that I wanted to do, and I was super mindful about how all of my little lifestyle expenses really did add up. I would see friends at cafes and I wouldn't order anything because I was trying to save money, and I just had this mindset of being extremely frugal. Thankfully, I didn't have to do this forever, and I was able to change my mindset as I was able to earn more money and also invest more money. So if you are in this stage, just know that even if you do have to be frugal for a period of time, know that it's not forever, and it definitely gets easier over time, especially as you earn more money and you have more money invested. You don't have to be super frugal throughout your whole lifetime. You can go through stages, and it definitely gets easier over time. So don't worry if you're in this stage, you can definitely get through it, and I totally believe in you. So the next stage is going from $1,000 to $10,000. Once you have over $1,000, things start to get really exciting, because you can start customizing your core portfolio and also readjusting your investing strategy based on what you've learned. I've been investing for 9 years now, and I went from $0 to $1 million in those 9 years. So here are some things I've learned throughout that journey. When you're starting out, you actually don't need that many ETFs in your portfolio in order to have a diversified portfolio, as long as they are complementary. The ones that I mentioned earlier are complementary because you might be targeting one market with, say, your Australian ETFs, and then the rest of the world with your international ETFs. So make sure when you are picking a core portfolio of ETFs that they are complementary ETFs and they don't overlap more than they need to. ETF overlap is basically when you have one ETF and another ETF in your portfolio, basically buying the same things. So you might think that you're getting more diversification, but you might not be, because you're buying some ETFs that essentially do the same thing. So I hope this makes you feel better that you don't actually need that many ETFs in your portfolio to have good diversification. With some ETF portfolios, you might only need one ETF. An example of a one portfolio ETF is VDHG. There's also DHHF and DZZF for an ethical version. All three of these ETFs are ready-made portfolios with instant diversification. You could also create your own ETF portfolio by investing in, say, 2 or 3 different ETFs that cover different markets and different countries. An example of a 2 ETF portfolio would be VAS and VGS, or FAIR and VESG for an ethical version. Like I mentioned before, this covers Australia and the international stock markets without them overlapping. And you get to choose how much exposure you want to Australia versus how much exposure you want to the rest of the world. Whereas the pre-made one portfolio ETFs, you don't really get to change because they're already set. Or you could even look into a 3 portfolio ETF. An example of this would be VTS, which is the Vanguard Total US Stock Market ETF. And you can combine this with VEU, which is the Vanguard All World Excluding US ETF. And you can even add VAS, which is the Vanguard Australian Shares ETF. So this trio would cover the US stock market and the rest of the world, and Australia as an optional add-on if you wanted a bit more exposure to Australia. Although VEU does have a small exposure to Australia in there as well. And if you would like to invest in any of these ETFs, or even look into other ETFs that you could buy, you can check out Pearler, which is the investing app that I use, and use my code Queenie for a $20 credit. When you're at the stage of $1,000 to $10,000 and you have more than $650 or $1,000 to invest, then it's a good idea to look into the full Pearler product. By looking into Pearler instead of Pearler Micro, you basically get a bit more customization in your portfolio instead of just the 10 managed ETFs with Pearler Micro. With the standard Pearler account, you get to access pretty much any ETFs or stocks on the Australian stock market and the US stock market. So don't forget, you can use the QR code here to download the Pearler app and use my code Queenie for a $20 credit. So once you're in the $1 to $10,000 stage, you start to get a bit more freedom in your life because you have your emergency fund set up, and it feels good knowing that you already have some money invested in your accounts because now you've put your money to work and your money is starting to work for you instead of being eaten away by inflation. And it's also a nice feeling knowing that you have investments working for you that you could potentially do whatever you want with whenever you want. I guess ideally it's good to keep them for longer if you can, because that's when compound interest can really start to work its magic. So the next stage is going from $10,000 to $100,000. And this is when investing starts to feel real and you really start to see compound interest in action. This is such an exciting stage because it's when you can see that your money actually starts working for you, and this magical thing that you may have heard called compound interest is actually working in your favor instead of against you. This is a stage where you might decide to start increasing how much money you invest, potentially even adding in satellites to your core portfolio. And a satellite is essentially a slightly riskier investment compared to ETFs that you may find exciting. Generally, as a rule of thumb, it's a good idea to have 90% of your core in ETFs and then use 10% of your portfolio for the satellite stuff, which is essentially the slightly riskier investments. For me personally, I have 90% of my portfolio in core ETFs and 5% in individual stocks, and the other 5% is in crypto. I only keep 2 cryptocurrencies, which is Bitcoin and Ethereum. It's also a time to actually start tracking diligently where your money is going and make sure that you don't succumb to lifestyle creeps, because it's amazing that you do have a good financial footing. And while you can definitely ease up the restrictions and spend more money on things that make you happy, and while it's definitely a stage where you can definitely ease up a little bit on the frugality, it's still a good idea to keep the spending under control and make sure that you don't succumb to lifestyle creep. At this stage, it's also a really good idea to start tracking your net worth if you haven't already. This is personally the stage where I started tracking my net worth monthly, and it's honestly one of the most motivating things I've ever done, and I also think it's the #1 reason why I've gotten to where I am today. Because if I wasn't tracking my net worth so diligently, I probably would have fallen off the bandwagon years ago and just started mindlessly spending my money, not realizing where it was going. And if you want to start tracking your net worth too, I do have a completely free net worth tracker in my description. This is also the stage where you might consider automating your investments. If you do have a regular paycheck coming in and you know what your expected monthly expenses are, it could be a good idea to start automating your investments so that way your money is working for you without you even having to think about it. And the amazing thing about Pearler is they actually do have this automated investing feature, and this has honestly been a game changer with my finances because it forces me to invest every month, but the great thing is I don't even have to think about it. And if I have any unexpected money that comes in, let's say for example from a tax return, I'm able to do manual investments as well on top of what I'm investing automatically. So if you care about financial freedom and setting yourself up for the future, I do highly recommend looking into automated investing. This is what the Pearler app is like to use when you set up your automation. So you simply go to the Automate tab, and then here I have my different automations, and then I can go in here and I can choose which ETFs I would like to invest in and basically set up how I would like to invest my money. If you have $10,000 to $100,000, this is actually the stage where you might consider adding in property to your investment portfolio mix, or even buying your first home. If you're based in Australia, there's actually a 5% deposit scheme, which allows you to buy your first home with only a 5% deposit without having to pay for lender's mortgage insurance. So let's say, for example, you're looking to buy an $800,000 property to live in. With a 20% deposit, you'd need to have a deposit of $160,000 in order to buy that home. But using the 5% deposit scheme, you'd only need a deposit of $40,000 in order to buy that exact same property. So this means that you can get into the property market a lot sooner than having to save a 20% deposit. Once myself and my partner had $100,000 saved, that's when we actually bought our very first home to live in, which was an apartment in Sydney. We bought that apartment 5 years ago, and looking back now, that was honestly one of the best investments or best things that we've done with our money, because we still own that apartment, but we've now bought a bigger home to live in, and that apartment that we used to own is now being rented out. And the good thing is the valuation valuation of that property increased from $500,000 to $720,000 in a period of 5 years, which is a pretty good return, especially for an apartment. It was an older apartment in a boutique block, so think an apartment that's kind of ugly on the outside, or like an ugly building on the outside, but we spent some money doing renovations to the kitchen and the bathroom and the flooring, so we were able to increase the value of the property quite a lot, and also the rental yield is pretty decent at around 5.5% too. And one of the most mind-blowing things is once you reach your first $100,000, you're actually 1/3 of the way to $1 million. That's because going from $0 to $100,000 takes the longest, because you're essentially working for your money and you're saving it, and compound interest isn't really able to take over with doing all of the heavy lifting. But once you reach your first $100,000, it gets so much easier because of investing in compound interest. So let's say, for example, you have $1,000 to invest monthly and you get an 8% return on your money from your investments over a 30-year period. As you can see here, going from 0 to around year 7 would be when you reach your first $100,000. But then you'll reach your next $100,000 only 4 years later. And then for your next $100,000, you'll reach only 3 years later, and so on and so forth. The crazy thing is, it only takes you around a year to go from $900,000 to $1 million. So as you can see from this compound interest graph, the first $100,000 is the hardest and it takes the longest, but after that it gets so much easier to build wealth because you have more money invested. So now let's talk about going from $100,000 to $1 million. So once you reach that first $100,000 milestone, know that the hardest part is over and it actually gets easier and easier to build wealth. So you can kind of ease up a little bit. You might be able to treat yourself a little bit more, but keep in mind it's still important to stay vigilant and make sure that you're still spending less than you earn and keeping all of those habits that allowed you to get here in the first place so that you don't undo all of your hard work. For me personally, as I mentioned, from going from $1,000 to $10,000, this was a stage where I really wasn't ordering any non-essentials. I would go out with friends for coffee and I wouldn't even order a coffee because I was saving so hard. These days though, I am happy to treat myself to a bubble tea or a matcha or a gelato, definitely more regularly than I used to, say about once a week. I used to not spend any money on beauty services, but now I get my eyelashes done once a month. Those are just some examples of things that I have changed in my lifestyle that hasn't really impacted my net worth that much as a whole, because I already do have quite a lot of money invested that's essentially working for me now. Another thing, as we started to have a bit more assets and felt a bit more comfortable, Pablo started to get his hair cut more regularly too. So it was an extra line item in our budget, but it's good that we're able to kind of reward ourselves for these new net worth milestones that we reach. So hope you can feel the same way as well if you haven't already. So I hope this goes to show you that you don't have to be extremely frugal forever, and you can ease up a little bit as you do start to have more money invested, so long as it doesn't derail your finances completely and doesn't make you go backwards. It's also a good idea to make sure that you are being tax efficient and you're not paying more tax than you need to about certain things. So just basically being a bit more strategic about the ways that you spend your money so that you're being more efficient. I personally set up a family trust with my partner Pablo, and this has enabled us to keep most of our investments in the family trust, and whenever we receive dividends from the investments that we have in our family trust, we're able to basically distribute that income to whoever we want throughout the financial year. So we make sure that we're not pushing one partner into a really high tax bracket and that person, say, paying 45% tax. We will basically distribute the investment income more evenly based on, tax brackets. Obviously, this does make our tax planning a lot more expensive each year because we do need to pay for the family trust and also the tax returns for the family trust and the companies that we have. So it's completely up to you about whether you think something like this would be necessary or not. Another good positive though is it also does protect your assets, because it means that your assets essentially aren't owned by you individually, they're owned by a trust. So that could be something worth looking into an accountant if that's something you're keen on. So those are the steps steps from investing $1 to investing $1 million. I hope you enjoyed this video and found it useful. Don't forget, if you would like to start investing and also automating your investments, I have put a link in the description below, or you could scan this QR code up here to Perla, which is the investing app that I use, and you can use my code Queenie for a $20 credit. And write snowball in the comments so we know you watched this video all the way through. Thank you. Bye.